everyone. Hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media. It's generally pertaining to three topics: commodities, financial topics, and or wealth building. All which I think are incredibly important because financial topics are what drive the market conditions that these investments work under. Wealth building is obviously something that's going to positively build and compound in your life if you start investing, which builds wealth. And then commodities are the spots that I think are currently undervalued that can build that wealth for you. So let's dive in here. Let's take a look. I'll give you my financial opinions as we go. And I'm going to sprinkle in whatever I want with all of the stuff that's being shared on here. If you want to follow me, it's at Finding_Finance. And if you want to join our community, we still have, I think this might be the last day to join with the holidays coupon code in the description link below. If you'd like to join, it is running out of time. So let's dive in. Let's take a look and see what people are talking about. I wanted to comment on this. I'm going to give my own comments here. He says some stocks are strong buys when they fall. Other stocks are sells when they fall. And how can you tell the difference? That's a really good question. And that is what separates very good investors between, I would say, not so good investors. And I'm not saying that I'm the best investor of all time, but my take on this is if the big overall trend, the big secular trend, a secular trend is a trend that occurs over a 10 to 20 to 30 year period. Interest rates falling for the last 40 years, well, that's a secular trend. Within that trend, there's counter moves. So you want to get the big trend right. You want to get that interest rates were going down, bonds and stocks were the two spots to be with interest rates going down. And if you identified the secular trend, which is now almost rooted in financial in the financial investment world, they think, certain percent stocks, certain percent bonds, and that they all do very well. They do not do well in an increasing interest rate environment for the most part. So as long as the secular trend is in place, it is a strong buy when a company falls within that secular trend in a cyclical pullback. Cyclical trends are shorter in duration and may last a year or two. And that occurs in a bigger secular bull market. So think of the waves that we see in Elliott wave and the big consolidation pullbacks that we get in wave 2 and eventually in wave 4, or the consolidations and pullbacks. Strong buys are also predicated off the value that the stock is offering you. So you can have a stock that is in a secular bull market, the service or the commodity goes up in price, but you get a cyclical pullback like a recession in that secular bull market. So let's just say that we've got underinvestment in oil and natural gas, and eventually we're going to have to increase that investment to increase production for the demand that's in the future. And we get a recession in the short term. That would be a strong buy scenario because you're in a secular bull market of oil and increasing prices with a big pullback within it. And that's the difference. In commodity companies and companies that are services to the commodity companies, like mining equipment and drilling companies and energy service companies, et cetera, et cetera. The most important thing is the price of its commodity. The movement of that commodity determines the balance sheet. It determines their margins. It determines and flows through that whole balance sheet. So when people say, well, what does the balance sheet look like? Really what you want to look at a balance sheet is how much debt do they have? Are they going to go bankrupt? Can they service the debt? Do they have cash? And what kind of leverage does their balance sheet have to the commodity itself? So if you're a big bull in oil and oil's trading at 70 something dollars today, and you think it's going to go to 150, you want to see how much leverage you get with the company. You can also look at previous trading and look at the fractals that it created. And the fractals are almost a direct reflection of the balance sheet expansion contraction given where the commodity price goes. And the biggest risk that you can have in a commodity stock is the stock goes down and they've got a boatload of debt. It sells off to pennies on the dollar if the commodity price goes low enough. That conversely is also why companies that hold debt will give you the potential buying opportunity of a lifetime because they get sold off to pennies on the dollar. A company with no debt will never get, it'll never go bankrupt, but it will also won't sell off as much as a company that's got a lot of debt. So it cuts both ways. It cuts going down because it can really hurt you. But on the other hand, it gives you massive leverage to the upside where you can just get monster returns if you can buy at a higher risk, pennies on the dollar type scenario. But you have to know what you're buying and you have to allocate your portfolio in a way where if it does go bankrupt, it doesn't kill your portfolio. The 10-year Treasury yield will surge to 5.5% this year, its highest level since May of 2001, according to Wall Street forecaster Jim Bianco. And Jim's pretty good. So he's calling for a 10-year Treasury yield surge to 5.5%, a multi-decade high. Well, remember, the interest rate determines the pricing of assets and commodities. And when yields go up, you'll see stronger dollar, you'll see stronger yields, obviously, and they move most of the time together. You'll also see, most likely, if that were the case, inflation, because inflation generally drives yields. I don't know what his reasoning is behind this. I just saw this coming up, and if he thinks inflation might kick back, you're going to see oil prices move. That's generally the translator of increased creditor dollars in relationship to the consumer price index, and the translator of credit into the CPI is through oil for the most part. So there's a high correlation between yields and oil price if you look at history. The stock market is either a gambling machine or a reliable wealth creation machine. The only difference between one and two is your holding period. Totally agree with that. The majority of people, their time frames are too short, and they're playing the game of number one. They're playing a gambling machine. They're like, oh, it's going to go up. Oh, no, it's going down. They're sell. Oh, no, it's going to chase the price performance. Look at this trend. I'm going to jump on this small, short-term little trend. And number two, a reliable wealth creation machine. That's where you buy undervalued companies and then you wait for potentially years or a decade. And then it builds wealth and you take all of the short-term emotional market-driven price movements out of the equation. And earnings per share is what drives the share price higher. So what you want to do, if it's possible, is you try to time your purchases as best you can. You're never going to be perfect in the timing of your purchases. You can use technical analysis, you can use stage analysis, you can do all sorts of things that you can learn to try to time it as best you can. But you also want to know that it's undervalued and that the trend is behind your back. That's that big secular trend that I was talking about earlier. You want that trend behind you. And what that does is it puts you in number two, a reliable wealth creation machine. But it's still hard to do that because your emotions are going to play with you. So as we continue to apply a simple three-step investment strategy, buy good companies, don't overpay, that's the value, and do nothing. Your time frame is long enough where you don't do anything. And that's where you can get to number two, a reliable wealth creation machine. Buy good companies, buy them undervalued, and don't do anything. Exactly true. Natural gas and storage setting a new 5-year high, been brutal for the bulls. And we'll see. We've got some really cold weather coming up next week, where we're hitting single digits as our lows. I think they even go under. We usually get a couple days under zero too, and I think we've got one projected to go below zero, -3 or something, coming up next week. Coming down, Stanley Druckenmiller on sizing from Michael however you say his last name. I don't even know how to say that. All right, so I want to go over this too, because this is absolutely important when investing. There's one thing Druckenmiller talked about. It was about position sizing. Broadly speaking, when you're trying to maximize your returns, you need two things: the expected value times the size of the position. One is you need some sort of edge. An edge means you have a belief or a mathematical advantage that's not reflected in the current odds or in the market price. The second thing is how much you can bet on that when you have that advantage. And the intuition is quite straightforward. If you had perfect information, you knew your bet was going to make you money, you would bet everything you could, right? And then there's the degree of certainty about that. So there's this relationship between edge and betting size. And that leads you to your total ability to generate excess returns. What did you learn from Soros? He said the main thing that he learned from Soros was that position sizing was 70 to 80% of the game. The reason that struck me is because, first of all, purportedly, George Soros made money on fewer than 30% of his trades. And that alone is worth letting settle in a bit. And he's one of the great investors of our time. So what does that mean? It means that he made a lot of investments that lost money. They probably did not lose a lot of money. And when he did make money, he made a lot of money, both by betting a lot of money and by letting it run simultaneously. And I've talked about this before in a couple clips before. You have to let your runners run. That's what makes you all the money. The symmetry that we're taking on, and that's what he's using. He's using symmetry here. The asymmetry bet has so much upside potential. You got to let it run if you want to make money. But you can also lose on a lot of the bets. Here, he's losing 70% of the time. Now, I'm not losing 70% of the time, but he's pushing his bets. And when you listen to Eric Sprott, he would say the same thing. He's like, push your bets when they're working. Continue to pile into the stuff that works. Cut the stuff that doesn't work. And I know a lot of people, oh, wait until it goes up and I'll trim it when I'm back to zero. No. If you have a better opportunity that you have more conviction in, go for it. That's the way I look at it. Lots of fun to come for commodity investors. And remember the secular trend that I talk about, the big secular trend. The secular trend is when you go from a low valuation to the upper valuation in commodities. We went from 98.99 to a high valuation in 2008, and that's exactly what we're doing again. We're going from a low valuation in 2020 higher. That is the secular trend. This here is identifying the secular trend. So the secular trend here is from mid 70s to basically low. So actually it's 82. 82 onward is a big bull market in the stock market because of interest rates and where the commodities are priced against equities. So equities are cheap at the top, and you want to be in equities in 2009 and ride this all the way down to about 2020, swap in 2020 into commodities and ride commodities higher. Same thing here. In early 1990s, you want to be in equities and ride the equities bull train all the way even to 99, 2000. Then you swap over to commodities and ride the commodities bull train. That is how you increase your wealth at the fastest pace through time with the lowest amount of risk. It's to identify that market, the big market trend, get involved with it, buy it when it's undervalued, and do nothing. That's been my strategy, at least. Here's a great chart. It says the market cap of the Magnificent Seven is now the same size as the combined market cap of the stock markets in Japan, Canada, and the UK. That's crazy, guys. 7 companies valued greater than all of those countries' equity markets. It says time in the market beats timing the market by Ken Fisher. Now this was interesting here too. It says I sold 262,000 of BTC and ETH for a client today on a major exchange. The trade fee to sell was $4,000 and the execution price was so far below the spot, she lost another $3,000 instantly. $7,000 to sell this stuff with frictional costs. And this is supposed to be a great investment. I mean, I know people complain about the premiums on on silver and gold and physical metals and stuff, but this seems quite high as well. Very high. I mean, $7,000 on 262,000. And other people are, if you read through the thread and you look, they're like, oh, well, you just needed to learn this and you need to go in and do this and you need to, all these things. And it's like, guys, if it's that complicated, I don't even want to go in it. That's my take on it. Take a simple idea and take it seriously. Buffett on expected value. So you want to take the probability of loss times the amount of possible loss from the probability of gain times the amount of possible gain. That is what we're trying to do. It's imperfect, but that's what it's all about. So the probability of a loss times the amount of possible loss, and then you just take the probability of the gain times the amount of possible gain. And then you compare those two. So what he's talking about is symmetry. What is the probability of taking a huge loss versus what's the probability of taking a small gain or a big gain? So what we want to do is we want to take a good high probability bet with a massive upside amount of gain. And we want to buy it at a time where the probability of loss is low. And if we do have a loss, it's going to be a small loss. And that is exactly all investing is about. You want small losses or small probability of losses. We want to buy it when the market's coming into favor. And we want gigantic upside returns with high probabilities. The market conditions is getting you the probability. The size of the gain is the ratio. And you multiply it together, and that's where you get your symmetry. Hardest thing in macro is dispassionately looking comprehensively at the incoming data, because there's always some data that supports any view. Think the US fourth quarter growth data is a good example. Lots of focus on weak data points when comprehensively it's pretty decent. So, I've noticed this with a lot of people too, YouTube especially. A lot of people will cherry pick data or present the data in a way that makes it look very bearish. You can also, conversely, take that same data, present it a little bit differently, use maybe total amount of vacancies versus a percent increase on some fictitious time frame that's made up. And you can make the data say what you want it to say based off of the message that you're trying to send to your audience. Be very careful on who you listen to. Be very careful on the data that they are presenting. And I would not take it at face value. You want to look at this stuff yourself and make sure that it is accurate. There are certain things that I would not look at from a percent increase. For instance, if inventory was at a very low level, at a level below 1 month, so you're literally at 0.3 months or half a month of inventory, and then you go to 1 month of inventory. 1 month of inventory is nothing compared to an average of 6 months of inventory. But what they're going to tell you is, oh, you have 100% gain in inventory going from a half month to 1 month. And that's just devastating. And it's like, no, it's not. Like, that's the market fluctuating. And it's only 1 month of inventory. And yes, the speed at which the inventory has gained in that period may or may not be an impact on the overall market. And then it depends on what cities you look at. If it's an overall number, there's so many variables that you want to look at. One data point also does not set a trend. So I would be so careful at looking at data from a lot of these people who, in my opinion, they don't know what the heck they're sharing, in my opinion, or they're trying to knowingly mislead people. Peak cheap oil a myth. Doomberg believes so. However, global conventional oil discoveries peaked more than 50 years ago. Governments weren't pushing green energy in the 1990s and 2000s, but still, conventional oil discoveries trended lower. So the growing gap of regular conventional, this is what they were finding for past discoveries. This is what we're finding projected in the future, and this is our actual production. When production goes above what they're finding, you're eating through previous inventory levels. So we're eating through previous inventory levels, and if you look, you can see oil discoveries here and what that looks like, and then you can look at what production, and we're gonna get a big gap in conventional oil. Some people will say, "Oh, well, that's okay. We'll just go into unconventional areas and mine it, pump it, whatever they want to do to get this stuff out of the ground." What a lot of people don't take into account is money doesn't drive it. Money is a symptom of a problem. A lot of people will say, "Oh, the price will solve everything." It doesn't, because your energy return on energy invested is where you have to look next. If you have a large decline in energy return on energy invested, so oil sands is really more or less a conversion of energy. It is converting natural gas into oil. That's really what it is. And the energy return on energy invested is 2.5 to 1, 3 to 1. You can make money as long as natural gas is cheap, but it's not really a net benefactor for energy into the system. You're just converting one energy source to another and emitting some sort of emission doing it. And then you emit emissions when you burn that other thing. So could it be worthwhile? Yes, there could be a premium paid on transportable oil versus natural gas that you have to transport in a pipeline. But that's kind of where we're going. So higher prices doesn't solve that problem. You could maybe take an energy source and convert it to oil through oil sands if there's some sort of non-pollution, completely expendable energy source, the sun or whatever. The problem with that is the sun is scarce in terms of its energy density when it hits the ground, and the earth is what gathers that energy density and puts it into oil and uranium and all these things, and it naturally puts the energy density into these deposits that we get out of the ground. All right, coming on back. Probably nothing. It will be a soft landing, folks. And this is the leading economic indicators have fallen 20 months in a row. Now, here's the thing again that I will say. This one was 22 months in a row. This was 24 months in a row. And notice at each of these peaks, the recession was before the peak. It was either in the middle of the peak or right before the peak. Like the recession preceded the move. Now, we probably are in a slowdown. And maybe we are going through it or we're in it right now. And we might come out of it here at some point, whatever it is. But a lot of these peak, and you can see that the recession occurred before the peak occurred. Is the peak at 20? I don't know. Is it 20 months, 22 months, 24 months? But I think we're in a recession probably. And we're probably coming out of that slowdown at some point here. For now, I would categorize the continued fall in job openings as a benign loosening of the labor market. Job openings falling without a commensurate rise in claims or fall in payrolls is distinctly unique to this cycle and points to a soft landing, says Warren Pies. So job opening peak, we can see claims are flat, opening minus 2.5 million, labor force plus 4 million, and payrolls continue to go up. So that is also very interesting, and he says that it's unique to this cycle, which there's a lot of things that are unique to this cycle besides this information here. It says what Stanley Druckenmiller taught Michael. Okay, we already went over that, but this is another one. I guess I shared it twice. The inverse correlation of gold and USD can be stronger shorter term, but longer term is not an issue. So it's been consolidating for 12 years. Should be time for another big breakout, looking at the similar red pattern inside the triangle. Time for another long period when gold outperforms the USD. And it says this chart fits well with the USD most probably has topped for good, as said when called the USD top back in September of 2022. So he thinks gold's going to go up versus the US dollar. JC says Santa was a no-show this year. The S&P 500 couldn't rally during this traditionally bullish period, but financials did as outperformance continues. So financials are outperforming the S&P 500. You know when they outperform? When there's a big housing market boom and they create loans to loan against the housing market. I think that's what's being priced in here, guys. And if that's the case, then we're square in the middle of a housing boom with an expansionary phase of real estate, which is good for commodities because the inflation is the demand for commodities. And as your credit expands faster than your supply, that's where you get the imbalance. It's credit demand. Demand is credit and credit is demand. And commodities is the final payment of that credit being created. And that's where I'm at it, guys. So that's what we've got for today. Give me a thumb up for the content. Subscribe to the channel. We've got a 7 a.m. Mountain Standard Time Saturday question and answer session coming up for you guys that are members. I'll see you there. And that's all I've got for today. So have a good day. This is Finding Value.